What are we going to do on the investment side? Well, our outlook, is it a time to buy? Is it a time to sell? Let's look into the crystal ball. Well, we certainly paid our dues. This is the average annual total returns by decade for large cap stocks in the U.S. Obviously, here's the 1930s, where we lost 0.1% basically every year for 10 years. And that pales in comparison, frankly, to what we've been experiencing here between 2000 and 2008. Nonetheless, the long run average about 10%. And you can see, we're paying the dues for what we enjoyed, I guess, in the 80s and 90s. But that has left us with plenty of values to choose from. This is a chart that goes back to about 1980 and asks what percentage of the companies in the S&P 500 are selling for 40% off. And that answer is 62% right now. Remember the panic in 87? Only 38% were selling at that level. And so there's a 40% off sale. Now, if I told you there was a 40% off sale at TJ Maxx or something, everybody would leave the room. But when it's a 40% off sale for the stock market, everybody thinks, oh, it's just going to get worse. Well, it's asymmetrical. We'll come back to that. Earnings can fall, and the stock market can still rise. Here's a sample of years going back to 1908 through 1991, and instances where earnings declined more than 10%, and yet we saw positive equity returns. Across that sample space, in these years, earnings fell 20%, pretty nasty. But in those same years, the market actually rose 20%. Why is that? Because the market is a forward-looking instrument. And so the earnings growth in T+1, the year following this year, was actually 24%, and therefore got represented in the previous year. So Bernanke, in his testimony on Tuesday, which was magnificent, by the way, you can order the DVD, but he said that 2010, if executed well in Washington from a policy standpoint, could be the road to recovery, okay? And if that's the case, and if GDP is growing, then you want to lead the market as much as you can. And so if 2010 indeed is a recovery year, then you want to start investing now. The other thing that the market kind of has going for it, in my opinion, is that historically it likes lower inflation. It means the multiples in the market can rise. And so here are the rates of return during representative inflation periods. We are in this zone right now between 0 really and about 2%. Previously in those type of inflationary environments, you've gotten between 15 and 20% as an annualized rate of return. Now the market does not like it if deflation completely, swamps the boat, but I don't think we're headed there. Stocks are also very cheap relative to Treasury bonds. The way you analyze that is you look at the earnings yield and you compare it to the Treasury bond yield. Well, this has changed a little bit. Treasury bonds are now yielding 3%, but that's still nothing close to the 6% or so that you can get from the stock market. That is the widest spread we've seen since about 1980. And so there's certainly value in stocks relative to bonds. And there's a ton of cash on the sidelines. There is $4.6 trillion sitting in cash right now. And if just some of that, which represents 40% of the entire market capitalization of the stock market, if some of that comes in, it's not going to take much to move the needle. Here's another chart I want y'all to remember in the middle of the night when you're awake. This movie that we're watching right now, we have seen this before. This is a chart that goes and takes a visual representation, a look at the average of the 10 waterfall declines in stock prices going back 1929 to 2002 or so. So the current one we're in didn't even include it. And basically what it says is you go through one of these waterfall decline periods, you find some sort of bottom, you go through a bear market bottoming process, you'll hear that language a lot, and then ultimately the recession ends, which is useful. Earnings trough after that, which is also useful. Forgive me for this pointer. And then coming out of that, the stock market can go on about its merry way. Well, let's take a look at the event that we're currently going through and see how well it overlays. It overlays pretty well. Now, it's not perfect in terms of magnitude, but it is from a time perspective. So here's where we are. We've taken another leg down, so we're right about here now. But we're clearly moving through a process that we've been through before. But it's not just stocks. Here's why we bought corporate bonds. This is the spread between high-quality corporates and treasuries. And when the spread is wide, that means those high-quality corporates are cheap. And when they narrow, you make money. Well, here we are at 560 basis points, 5.6% above treasuries. That's the widest spread between corporates and treasuries since 1933. Now, Duncan, if you owned corporates here and spreads narrowed that much, was that good? Yes, very good. So we can make a whole lot of money on corporate bonds coming out of this cycle, just like I believe we will in stocks. There's another thing I think the markets have going for them, and that's that the sirens lured everybody out to sea on hedge funds, derivatives, private equity, venture capital, all these low-risk, high-return ideas that were illiquid, not transparent, and not regulated. Well, a lot of that money's come out and gone into cash. I don't think it's really going back there in any magnitude, which means it's got to spill into the stock and bond market. So I think the alternative side of the equation, which had been very popular, has burned everybody, and now the traditional side of the equation looks more attractive. And so our forecast, our brave forecast for 2009, is that we believe on the equity side that we can climb modestly higher by year end. Yes, I know we're down 15% or wherever we are right now, so we need a 20% move to get higher by year end. Guess what? We had one, November 20th to January 2nd, and we outperformed. It's exactly what we needed to do. We think that can happen again by the end of the year. In terms of size, we are favoring small to mid-cap stocks over large-cap stocks. In terms of style, we are favoring the growth style right now over the value style. Why is that? If you're a growth company, you generate a lot of free cash flow and you don't have to go borrow money from a bank when they don't have any money. In terms of domicile, we're still favorable on the United States versus the international markets, although I'll tell you we are warming on Asia, but getting the timing of that right is very important. In terms of U.S. interest rates, we're going to issue a lot of debt. In fact, we brought back the 7-year Treasury bond today. And so the debt curve, we think, is going to rise as that supply has to be absorbed. In terms of the U.S. dollar, I think continued strength. There's turmoil in the world. Europe's kind of nervous right now. And Asia's pegged to the dollar. And so it's not a bad environment to be in the U.S. dollar. And we've brought a lot of our holdings back home. And we believe on the bond side of the equation that corporates will outperform treasuries, which is another way of saying that credit risk outperforms. And so that's our fearless forecast.